have a new edition for that. We decode markets, macro and money flows in, of course, the ET Now Masterclass. And this time around, we're doing it with market veteran Raamdeo Agarwal. Will an earnings revival bring FIIs back to Dalal Street? And is the capital market theme gearing up for its next big run? Listen in to a slice of that exclusive chat we had with regard to this.
I would think that PSU banks are cheaper to buy, and they have cleaned up their act, because whatever happened between 2008 to 2020, it got completely cleaned up in 2020. There's no directed lending from Delhi. So now these banks are really professionally managed. Technologically also they are more or less up to the mark, particularly the few of the larger banks. So I would think that why should there be so much of, in fact, there is no leadership crisis in public sector banks, because
Yes.
I mean, if somebody is appointed for 3 to 4 years, everybody knows that the system works with the 4 years of CEO leadership. In private sector, the banks are led by 15, 20 years of very charismatic leader, and when he goes, there is a problem. So I would think that large public sector banks like SBI and all, particularly SBI, looks very, very attractive.
And this is going to drive, you said, rate sensitive sectors going in the next year or two, as credit growth, led by credit growth, which is coming.
So there is a domino effect, there is a multiplier effect. You buy house, then housing leads to purchase of plumbing items, then furnishing items. So all kinds of labor and all, and what the labor spends on. So I don't know how it works in the economy, and nobody can figure out. But it will start with the rate sensitive, and then it will flow to the other consumption items. So overall, there should be a pickup as we go forward, quarter on quarter.
One of the biggest challenges which we are facing is with respect to geopolitics, right?
That is
India-US trade. You're talking about a trade deal which is now started impacting all the export sectors, actually. How do you look at it?
So you have to be careful. You have to see, because it's not only America, it's the whole world. Multilateralism is changing, and this last 1.5 years of Trump's second term, everything looks topsy-turvy. Every country is trying to become Atmanirbhar. You know, earlier Modi ji talked about Atmanirbhar Bharat, but now everybody wants to be Atmanirbhar. So they want to have bilateral kind of a relationship in trading. America is targeting deficits country-wise, you know.
Yeah.
So I think those things will have a huge repercussion. I don't know how the world will come out of this. Good thing is the countries with their own domestic demand. Like, so the biggest asset is you don't have control over the global demand.
Yeah.
But you have control over your own demand. So how do you judiciously use this power of using your own demand? Fortunately, we are not that much dependent on exports. Yes, export is a very large portion. Services 50%, which is so far not impacted. Merchandise, you know, you have all the challenges of this trade deals and all. But your domestic is completely yours. You know, that's about 70-80% of the economy. So that part, how do you spend? It's an economy with what you call huge, consumption, appetite, I would say. And so how do you enhance the purchasing power? And see, and that's what government is doing. My sense is they're making the goods cheaper. They're leaving more money on the hands with the lower taxes, direct taxes, lower indirect taxes, lower cost of money, and more credit. So I think government has done everything, and they can do more of the same thing in the coming budget.
You know, one of the things which we've seen because of this time correction that has happened, domestic flows maintaining the index at 26,000, and while earnings have been, you know, tepid at 8 to 10% every year, which is growing, is the, you know, derating of some of the classes of stocks which were trading at a very high PE, where we have seen now earnings growth is also now a questionable thing. Your P is around 5 times your earnings growth, which is coming in some of the cases. How is it a time to look at these stocks with a different lens?
Yeah, I mean, this is always when a market is the craziest stuff. Mr. Market will either they'll be very depressed, but the growth is 20%, but they will give you a multiple of 10 or 12 or 15, like banks. Okay. Why the PSU banks have done very well? Because they were trading at 3, 4, 5 P multiple.
Yeah.
And they were growing at 15, 20%. So obviously it was a half peg or less than half peg. So it did very well. And then you go overboard when some of these fancy companies, they start growing at 40, 50%. They will take it to 100, 150, 200 P. Any price is right. High growth, high quality, high growth, any price. Then you suffer, no? Because ultimately stocks are stocks. I mean, you are buying a dividend paying earnings machine. So you cannot pay a very high price. You just cannot pay a high price. Just because there is momentum, a lot of speculators come. I mean, a lot of fund managers, they look to be investors, but they're actually speculators. So they speculate on कि भाई अगले साल again, there's going to be 80% growth in the profit, and hence I can get 40-50% return on the stock. But for some reason or other, maybe credit growth has gone or something, the earnings decline. Earnings don't grow at 80%, but it grows at 20-25%. So the 20-25% is damn good earning. But stock is building in 80%. There is a disappointment. So market will, I mean, all these speculators, they come to sell and there is no buyer.
Some of the Baki stocks, like a Trent, which was trading at multiple 80, 90, 100 PE, at that time growing at 40, 45%. And now, suddenly we're seeing that the company itself saying that I'll grow at 20-25%. And reach, which is a very good growth, but much below street expectation, which is there. Is it time to, still hold on to that kind of
You need to know
story?
a lot more. You need to know a lot more for me to say anything on this. So I would not comment on what to do in Trent. But I mean, the company is not victim of anything. Company is going at the pace at which they're doing brilliant job. Judios, ye wo sab kar rahe hain wo log. But I mean, if you do excessive pricing of the stock, then of course stock will be victim of correction, not the company.
And that you'll see it's many of the stocks where
lots of them
where the growth has now tapered down.
This is very famous stock, but the whole lot of it, and that's where I think the excessive valuation which has happened in the last 4-5 years, because there was a demand shock when the retail investors started coming in 2020. 30 lakh investors every demat accounts opening. Obviously, there was a massive demand for the paper.
Yeah.
So the mutual fund, through the direct, in all kinds of speculative as well as investing. So when there is a demand shock, so stocks started flying, and the stocks which were small, what they call float, they flew more. The ones which are big, the speculative tendency was not there to go there. So now there is a supply shock in the market. All kinds of IPO, QIP, promoter selling, FI selling, everybody is busy selling the paper. But my retail is also so robust, so there is a kind of a floor. Market is not going below 26,000 or 25,800 or whatever is the number. It is sticking at around 26,000. All kinds of bad news are flowing through, and yet market is steady at about 26,000. So which is a terrific resilience,
But we always say that foreign flows is something which drives momentum in the market.
Yes.
That momentum is absent for last 12 months.
Yeah, it will remain absent for next 12 months again, because that's the arbitrage machine between India and rest of the world. It's a pipe between India and rest of the world. When you imagine, it's like if you are at 25p and rest of the world, I'm a relevant world, like I'm saying, emerging market is at 15p. Which way money will flow? The guy is sitting in first thing, America itself is doing so well. So very little money is coming to the emerging market. Now whatever little is coming, money will definitely. So money is not coming actually. So what people are doing, people are readjusting the allocation. So India has become the funding market for rest of the emerging market. So if you want to go to China, where it is say 15p, where at 25p, so they are selling say 20% in India, because India is giving the liquidity as well as the price.
Yeah.
You are selling here and buying at 15p in China, and that's why they have done very well in last 1 year. Now, so my sense is there are only two ways to counter the FI selling flow. One is that we come down to, my P multiple comes down to 18, 19. Now P multiples to come down to 18, 19, there are two ways. One, you actually correct the market, which is not happening. Second, your earnings take a kind of a flight.
Right.
So in next 1 year, if earnings grow at 20%, then that 22 becomes 18 in any case.
Yeah.
So then FIs will actually come. So if the earnings momentum pick up, I don't have any doubts. All FIs will be sitting here.
And do you think that earnings will go up to 15 to 18%?
This is this we have to see. I mean, you are in the channel. You can pick up all the nifty companies and interview them in 2 days. I mean, I don't have that kind of capability.
But from your experience, do you see this kind of thing, because we are talking about a credit growth picking up, the multiplier and domino effect coming in, and then may not be in a quarter or two, but maybe in 3 to 4 quarters, how this...
I would be very bullish I would be bullish on the earnings growth for next 12 months. Market, what they will do, whether they're correct or, I mean, whether the P multiples will go up or stay here or go down, I don't know. But earnings should pick up in next 12 months.
How do you look at picking up compounders in this market?
Yeah. So it's a very tough call. I mean, see, you need a lot of patience. See, the data and rationality has to overrule any kind of emotion. If a company is run by God, but it is making losses, don't go anywhere that. G is equal to R. The companies which are growing at 20%, that will give you final return of 20% only. And the companies which are growing at 5%, they will give you 5-7%. And the companies which are in losses, you have no hope in hell to make money there.